Premium workspace demand is rebounding in Asia Pacific with hybrid work models impacting occupancy rates. To know more about this, we have Mike Davis from Colliers, Tim Armstrong from Knight Frank, and James Taylor from JLL. First off, what changes in Asia Pacific's commercial real estate market are driving this demand? Starting with you, James.
So if we're looking at sources of demand, I mean, while tech firms are still a significant source of demand in 2024, I think APAC leasing's been dominated by perhaps the more traditional CBD tenant types, the banking and financial services sector, as well as other professional services firms. And by market, I think India stands out as an outperformer. Now, some of these firms are taking more space, some are taking less, but I think all are evaluating what they need in terms of their portfolios and their footprints. Many are taking the opportunity to rethink the type of space that they need and what they might need in the future. So across all APAC markets, corporates are upgrading from older legacy office space to newer, higher quality workplaces, and that's especially as renewals come around. And I think this kind of space is best placed to deliver the kinds of amenities, workplaces, and sustainability credentials that corporates need and their employees are demanding. And I think it's this upgrade demand that's underpinning a lot of the market activity at the moment.
Yeah, sure. So just to add what James said, we're seeing a flight to quality. So demand for premium workspace in major cities like Tokyo, Singapore, Sydney is rebounding, while hybrid work models continue to influence occupancy rates in many other markets. Occupiers across the region are willing to pay higher rentals for better quality office and amenity-rich locations to drive talent retention and acquisition. In Asia Pacific, we're having that much greater pull to the office, creating higher occupancy than in Europe and the US, and that's causing continued upward pressure on office rents across the region. And for those cost-conscious global occupiers, many are looking at global capability centers in markets like India, where GCCs are expected to contribute over 40% of office leasing in the next 1 to 2 years.
Yeah, I'd just add, I think Asia Pacific it's a well-balanced market by and large. And I think there's sort of three factors that come into play here. First is the product in Asia is traditionally good product, very good office product, newer office product, or a significant portion is, especially compared with the US and Europe. And that works with what tenants are wanting, what tenants want from a building, that sort of flight to quality that's been mentioned. Also, businesses are focusing on Asia. They know it's got a really strong talent pipeline. They know that it's got quality outputs. And it's a great place to put the capital at the moment. And a third preference, the third thing I should say, is there's a cultural preference to be in the office. So the demand side is there. People want to be in the office in Asia. You look at the occupancy rates compared to the rest of the world, and it's traditionally very strong in this part of the world.
So that's for driving the demand. But how do you see our need for offices changing across Asia?
Yeah, the hybrid's obviously a huge buzzword at the moment, and that's had an impact on a few layers. I think what happens in the office, there's obviously the me versus we space, the need for the collaboration areas and so on. So businesses are looking at what they do within the office space that's affecting the form and function and the direction of travel that they take there. But I would say it's a nuanced position. Every business has different drivers. Some have more sales force in there. Some have more back office. So it's a nuanced position in that regard. But then, as we've touched on, it's that flight to quality. I think hybrid has exacerbated the direction of travel that was in play pre-pandemic. The flight to quality is about a flight to flexible lease terms. It's about a flight to amenity, and it's a flight to sustainable buildings. So hybrid work has really sped up all those, and the direction of travel is really, really set now to better quality space.
I agree with everything there, but just to look at it through the lens of decision making. Now, employees globally are coming into the office something like maybe a bit more than 3 days a week, and that's higher in APAC. It varies market by market. And if you add to that uneven occupancy across the week, it might peak on a Wednesday and it might drop off on Monday and Friday. And that makes decision making around portfolios and workplaces much more complex than it used to be. I think to make good decisions, firms need accurate real-time data on how the space is being used. So most firms at the moment, and this is the case in APAC and globally, most firms have simple badge swipe data, and that tells them who's using the office and when they're using it. But most don't have the more granular data that comes with things like more sophisticated workplace sensors. So corporates, I think, need to invest in the technology. They need to capture data, and then they need to use that data to make good decisions around the portfolios and the workplaces.
Yeah, just to add to that, we think the trend towards flexible and efficient space utilization will continue. According to our recent Global Corporate Real Estate Strategy benchmarking report, 80% of CRE leaders plan to reduce or maintain their office space by the end of 2026. There's a growing preference for flexible office spaces that can be easily adapted to different needs. This includes co-working spaces and offices that can be reconfigured for various uses. Companies are looking for that space that supports both in-office and remote work, with that clear trend towards more flexible, tech-enabled and employee-centric work environments.
So considering all these shifts, Mike, are companies looking for more flexible leasing options, or are they still into the long haul?
Like anything, I think the answer is it depends. Many companies are really prioritizing flexibility and being nimble. Others that might be located in more challenged markets are choosing to leverage their situation to realize immediate cost savings and are committing to longer term leases. Those that are willing to commit long term are seeing landlords in many of those markets offering concessions to get them to make that commitment. But again, many other organizations are prioritizing flexibility in their real estate portfolios and designing workplace strategies accordingly to bolster that resilience against market fluctuations and adapt to their ever-evolving organizational needs.
Yeah, I think Mike nailed it. It does depend, and there's variation in the conversation. Each business will have different drivers. Some will want the long-term security and tenure, whereas for many, the business and the operating environment is fragile. We do a quarterly sentiment index of corporate real estate leaders, and we can tell from the last read that it is fragile. I think many people thought rate cuts would have started to flow through, but inflation's proved harder to tame. And so businesses are grappling with higher costs, and it's an uncertain and complex environment. So if it's uncertain and it's complex, then certainly flexible leasing comes into play, because it is difficult to forecast things like headcount growth in the current environment. So certainly flexibility has a role to play in that regard.
And if we're talking about, for example, relocations or new leases, there are significant capex requirements there. So I think if occupiers were willing to take on these quite significant initial costs, which they often are at the moment, especially for buildings with, for example, better sustainability credentials, then I think they're unlikely to be planning on moving out after just a year or two. But then again, things do happen, and with the uncertainty of the last few years, I think if occupiers generally are able to build flexibility into contracts, and that might be the ability to terminate a lease early with minimal penalty, then I think they'll be very happy to do that. Now, whether a landlord would agree to those terms or not, I mean, that depends, and that's going to be dealt with on a case-by-case basis. It's going to depend on the building, sub-market, the market, and that tenant-landlord relationship.
Now, to close the discussion, where do you all think is this commercial real estate market heading over the next few years?
So now that the dust has settled on the pandemic, I think it's clear now that offices will remain central to corporate strategy. We've just got a new Future of Work survey that's coming out, and that shows us that almost 1 in 2 corporates are mandating a return to office for all employees in APAC. But that said, I think firms will continue adjusting portfolios and mapping portfolios to their specific business objectives and talent objectives. And I think the focus on quality will continue. So along with rent and location, we've mentioned sustainability a few times today, but sustainability is one of the top priorities for occupiers when looking at new space, and the focus on green space will gain momentum as the 2030 intermediate ESG targets are approaching. I think green building certifications are non-negotiable now for many corporates. And we are going to see shortages of sustainable buildings in essentially all markets across the region as 2030 gets closer. And I think there are clear messages there for all real estate stakeholders. I think occupiers need to lock in that space sooner rather than later if they can. I think developers, I think most know now that they need to build high quality and they need to build green to attract tenants. And I think the opportunity for landlords of existing older buildings is in retrofitting for quality, retrofitting for green. And if they don't do that, they're going to face obsolescence.
Yeah, I mean, adding to what James has said, we're ever the optimist in real estate, so optimistic about what's ahead over the coming years. But I do think it's going to be very much a two-speed market. So the A-grade product will have strong demand, it'll have rental growth, and we'll see plenty of opportunity there. The B-grade market will be soft. Demand won't sort of naturally go that way, and I think the rental growth will be muted in that respect. And then the other thing, very optimistic about some of the lower cost markets. They're often counter-cyclical to harder economic times. We've spoken about India early in the GCCs there. I suspect that markets like Manila, India, Thailand, Malaysia, etc., some of those low-cost markets will actually do very well, where the cost of real estate's cheaper, the cost of talent is cheaper as well. So, look, as I said, ever the optimist, somewhat fragile sentiment at times, but I think Asia fundamentally is well positioned.
Yeah, my view is pretty consistent with James and Tim. We expect to see that trend of flight to quality continue. According to our surveys, 60% of CRE leaders are prioritizing sustainability when making real estate decisions. So that focus on sustainability and technology will continue and will be crucial to attracting occupiers and investors who prioritize eco-friendly and technologically advanced properties.
Thank you so much for your time today, James, Mike, and Tim.
Thanks.
Thank you.
Once again, those were Mike Davis, Colliers Managing Director of Occupier Services for Asia Pacific, Tim Armstrong, Global Head of Occupier Strategy and Solutions at Knight Frank, and James Taylor, Head of Work Dynamics Research at JLL in Asia Pacific. For more news, visit realestateasia.com.